Thank you, Bill. Thank you for having us here tonight. Very excited, all the enthusiasm in the room. Energy feels great, so this should be fun. We're gonna do some prepared fireside chatting here, and then we'll wrap it up with Q&A, so we will get to your questions. But first, as Bill mentioned, Cathie started ARK just over 11 years ago after X number of very successful years in the industry, many years as an economist. Yes? You want to say it?
No, my number of years in the business?
Yeah.
I started almost 50 years ago. And I'm proud of
A badge of honor, for sure. And still here, and still...
Well, it was when I was in college, I should add that.
But, you know, you had a very successful career, and you felt so compelled by innovation that you took your own money to start ARK. What was it that made you make that move 11 years ago?
Well, our business had become, well, I'll step back and say, our business started to turn radically from when I started in the business. So I started when I was in college in the late 70s at Capital Group on the West Coast. And I spent the next 20 years, it was Capital Group and Jennison Associates for the most part, in a world where active equity management was what ruled. And then we got to the tech and telecom bubble and the bust, and something started to change. We began to see people actually thinking more and more about benchmarks. We did not think about benchmarks in the 80s and 90s. We might have, as a courtesy, provided a benchmark, and oh, by the way, here's a broad-based index and how it did. But we weren't trying to beat it or not beat it, and that was just a courtesy. So tech and telecom bust, some benchmark sensitivity, 08-09, benchmark sensitivity, and an accelerated move to passive. And we felt that the world was changing at a more rapid rate, and that the technologies, the seeds of which had been planted in the 20 years that ended in the tech and telecom bubble, that those seeds were germinating and were going to produce some very interesting results. And I felt that the market was no longer doing research on the 5 major innovation platforms that Bill called out there: the robotics, energy storage, AI, blockchain technology, and multi-omic sequencing. And yet we saw the opportunities for scaling into these technologies were beginning to increase. And so that's why I started the firm. I said, no one's doing this research. In traditional asset management firms, there was a new mantra, get as close to your index, and for business reasons, stay close to it, and you'll be fine. I didn't agree with that philosophy. I've always thought, well, we've always invested in technologically enabled innovation, and that's all about the future. Whereas benchmarks, at least the stocks at the top of the benchmarks, are there because they have done so well historically. And they may continue to do well in the new world. But if we're right, not nearly as well as the companies that we are seeing embracing these new technologies.
And understanding what the future looks like and sizing these opportunities requires that you kind of break the mold, right? And so you set up the firm in a really unconventional way.
Yes. One of the things we believe is that these 5 innovation platforms, which involve 15 different technologies, they are going to scale across sectors. And we felt that, and boy, is the healthcare sector a great case in point today. In the healthcare sector, healthcare analysts are not comfortable with technology. They're not. this idea of, move fast and break things. In that world, not what they do. They're used to their phase 1, phase 2, preclinical, phase 1, phase 2, phase 3. They know what to do with that. But the new technologies that are entering healthcare, importantly artificial intelligence, are going to transform healthcare as we know it. It's probably going to be the most profound application of AI, but no one was doing the research. So how have we set up our research? We've set up our research so that analyst responsibilities are organized not by sector, not by industry, not by sub-industry, but by technology, those 15 different technologies. And so an analyst at ARK is focused on how these technologies are going to scale across sectors. There's no turf warfare, right? Tesla, for example, good case in point, is not an auto company. Of course it is in some way. But in order to analyze Tesla correctly, it was important to identify what it is. And it actually is 3 different technologies converging as we move towards robotaxis or autonomous taxi platforms. So there are 3 of the major platforms that Tesla embodies. Robotics, autonomous vehicles are robots. Energy storage, they will be electric as we continue to ride down that cost curve, and it becomes much less expensive than the internal combustion engine driven car. And AI is going to be, robotaxis are going to be powered by AI. So we don't have one analyst on Tesla. We have 3, robotics, energy storage, and artificial intelligence. So collaboration is also critically important. I remember being at, in the traditional, I've witnessed this in sell side, buy side, where, let's just take Tesla. The auto analyst was not going to give up that stock because the director of research classified it as an auto company. So we, because of the way we had defined it, got to the right answer faster than most did. And so, again, I think that's going to happen more and more. And even the traditional world is beginning to understand this, because think about what happened to technology, the GICs. It was split into tech and comm services. Technology is blurring the lines between and among sectors. And we think we're going to see more divisions like that as GICS, or the organization around GICS, tries to understand what's going on in the marketplace out there.
So innovation has had some tough times post-COVID. It felt like we could do no wrong in 2020, and we faced some significant headwinds post-COVID. Mm-hmm. And it seems like those are turning into, or the headwinds are turning into tailwinds. We also have a new administration. So I'm sure the audience would love to hear your thoughts on where we've been, where we're going,
okay,
and how the new administration will impact innovation.
Sure. So, yes, in the first 5 years of our life, interest rates went up, interest rates went down. We had really good performance. And then COVID happened. And I remember the 1 month as we were all saying, oh my gosh, are we going into a depression, a global depression? And remember, the market just sank. In 1 month, the market, depending on which measure you use, was down 25 to 30%. Our flagship was down 46%. But during that time is when I started something called In the Know. It's a video that I do every Employment Friday. Because I felt very strongly that the panic would subside, and I was trying to actually hold our investors' hands, but it seemed like many investors were so concerned they were tuning into everything they could get their hands on. So we got a lot of viewers around that time. And one of the things I said, well, besides, it's obvious now. Look, every government authority in the world is throwing money at this problem. If they don't solve it, then we have worse problems than a down market. So, but I felt very strongly that this was going to be that there was going to be a boom coming out of it, and there'd be bottlenecks and supply chain and all of that. That is history now. But at the same time, I also said, wait a minute, because what was getting killed was our multiomics or genomics portfolio. And so on those calls, I was saying, wait a minute, who do you think is going to solve this problem? Who's going to sequence this virus? Our companies are. Who's going to develop a test to see if people have this virus using synthetic biology? Our companies will do it. Who's going to discover the vaccine? Our companies. Innovation gains traction during tough times. And a lot of people bought into that. And we were up, this should never have happened, but 360%, right? Yeah. In 11 months. So, and I remember at the end of that saying, keep some powder dry, this is not the real world. But since then, it has been a very volatile world for innovation. First, coming down off of those valuation levels, then facing an interest rate shock, the likes of which we've never seen in history, a 24-fold increase in interest rates in little more than a year's time. I was around during Volcker's time, and many people say, of course we've been here before. We were at 20% interest rates. I said, no. Yes, we're at 20% interest rates. But that was up twofold, from 10 to 20%, and everyone had kind of gotten used to inflation in the 60s, 70s, into the early 80s. So it wasn't exactly a shock. This was a shock, a 24-fold increase in interest rates. And it set up these reverberations that have been very difficult. It was very difficult for any long duration strategy. Long-term bonds had their worst performance since the 1700s. So any long duration strategy was going to be crucified in that environment, and we most certainly were. So we've gone, though, from facing actually 3 headwinds. Interest rates, valuation was one, interest rates, the shock was another, and then the third was increasing concentration in the markets towards very few stocks that are very mature, have done very well. Now we call them the Mag 6, and that's just not what we do. We're trying to pick the new Mag 6, and the companies and stocks that will become parts of indexes in the future. Most of our names are not part of indices. We're a very good diversifier when it comes to innovation because we don't look like any benchmark out there. So those 3 headwinds are now turning into tailwinds, and it's in process because we're still in a volatile period. Interest rates, you'll notice, long rates have come down. We think that and in fact, is it the Fed Atlanta now? Is it Fed Atlanta now that projects GDP? Yes. Well, it's now saying we're going to see a 3% drop in real GDP in the first quarter, roughly. It doesn't surprise us, and it doesn't worry us either. There was a huge rush of imports which detract from GDP. There is something else going on, however. We think there will be a decline, and there could be another one in the second quarter. mostly because we're at the end of a rolling recession. The last shoe to drop is high-end consumer, and it is starting to capitulate. I think Walmart, who had been touting, hey, high-income earners are coming, we're gaining share there, it had to pull back dramatically on its forecast for this year. It doesn't like what it sees. From our point of view, this is not a panic situation. What it is going to do, because it's going to be accompanied with lower than expected inflation, it's going to give this administration and the Fed more degrees of freedom to do what they wish in the next 6 months. And I think the market's going to will look through the weakness in economic activity in here and begin to discount what we believe is going to be a productivity-driven boom. And we're pretty excited about what's going to happen. So first headwind, interest rates, we think they're coming down because of this decline in economic activity. And even when we move into strong economic activity, interest rates going up do not hurt our strategy necessarily. In 2017, interest rates went up, 2018 went up. We were very strong both years, up 87% in 17, way outperforming any broad-based benchmark. And we were up in a down market in 2018. So it's not necessarily bad if interest rates are going up because we're in a productivity-driven boom. That's a good news thing. We don't think long rates will follow short rates the way they typically do. And we wouldn't be surprised, for those of you in the fixed income markets, to see an inverted yield curve as we move into a productivity-driven boom environment. So we don't have the interest rate headwind. We don't have the valuation headwind anymore. So our valuations were through the moon after that 360%. Today, we're very close to a market multiple, closer than we really ever get. We got closer last year during the unwind of the yen carry trade, but the valuation premium that we assume is going to disappear in our 5-year forecast, we don't have to make that assumption because we're so close to a market multiple. So that headwind is gone. And then the last headwind, which is beginning to dissipate, it's, depending on the day, is the market is beginning to broaden out. So if you look at concentration, this bout of concentration in the US equity market has been the most concentrated, for those of you who have seen the Goldman study, in history, even worse than the Great Depression. Great Depression, this is really saying something. In the Great Depression, the unemployment rate went up to 25%. Real GDP dropped 25 to 30%, and prices dropped 30%. Okay, back then I understand concentration. Binary decision. Is this company going to live or die, right? We had more concentration in the last year than we did during the Great Depression. That tells me, and it's really what I think will be the grand finale of this move towards extreme benchmark sensitivity and ultimately passive, if we're right about what's going to be rewarded in the future. These very big concentrations in the market end in one of two ways. There have been about 7 of them through history, and they either end in a bear market, so that was the tech and telecom bust, and the end of the Nifty 50 in the early 70s. So that would be bad. And that was, when I looked at the chart the first time, I said, oh no. But then we looked carefully at the other ones, at the other concentrated moves. All of the other ones ended up in a bull market that actually broadened out. In other words, the fear that was represented by that concentration, crowding into, tried and true, safe, lots of cash, what have you, that dissipates, and the bull market broadens out. And that goes hand in hand with what I just said about a productivity-driven boom. And we really do believe this is the way this is going to play out. And it will favor, as you said, these were headwinds we were facing. It will, we think, play out so that now all of them will be tailwinds to our strategy.
And that coupled with some of the changes in policy, some policy shifts that we're seeing. You mentioned multi-omics or genomics, probably being the most, that space was absolutely decimated through post-COVID.
Yeah.
But some changes there, the FTC
Yes.
being more constructive on M&A activity will help with price discovery in the genomic space. Crypto or digital assets, we like to say now, sounds nicer,
Yes.
should benefit. You want to elaborate on some of the
Sure.
policy shifts?
So regulation protects big companies who have big lobbying organizations. It really hurts the small business sector. If you look over the last 3 years, what has happened, the difference between the way profit has evolved for large companies versus small. You'll see that the large company profits are up double digits. Small company profits are down 30%. That's a cumulative number. Small businesses have been crucified. Again, we tend towards smaller companies as well. This administration believes in deregulation and wants lots of competition, new ideas, entrepreneurial zeal, animal spirits. And so getting Gary Gensler out of there is bringing crypto back, innovation back to this country. I was looking at it and I was very vocal saying, wait a minute, we are losing all blockchain technology is the part of the internet that developers did not build in the early 90s because nobody knew that financial services and commerce would take place on the internet. In fact, quite the opposite. Everybody said, I would never put my credit card on the internet, and now look at us. We have a very inefficient solution. Now we're building a layer directly into the internet, peer-to-peer, transparent, that will take away longer term that 1.5% to 4% tax that we pay on everything, the toll takers are not bad guys. They're just trying to lower the risk in the system. Blockchain technology, transparency, peer-to-peer solves a lot of that problem. So Gensler's gone, crypto's back, and this administration is doing a world of good for that particular space. Going to have a big confab in Washington, D.C. to celebrate crypto. So that's crypto. FTC, Lena Khan, she was just Ms. No, no M&A. And the M&A world died, if you're listening to, and a lot of research died with it. We used to think, we were used to scope the scene and see who's doing the kind of research we're doing. And it was the bankers, because they were trying to educate people. They were trying to do deals first and foremost, but they were trying to educate people that this company, this new company, is worthy of financing because this big new thing is happening. We lost that research. We're not seeing that research anymore. In fact, many people say, and many of the companies, to whom we talk say we're the only one doing certainly the top-down kind of research that we're doing. We're as bottom-up stock research driven as any other team out there. But we do pride ourselves on our top-down work and the rigor behind it, really focused on a relative of Moore's law. It's called Wright's law, and helps us ascertain what the learning curves associated with each technology look like. Learning curves are expressed by cost declines, and so we're able to discern based on how quickly units grow, how quickly costs will fall. And that's why we're able to get to the forecast we are. So deregulation broadly, but I think this administration does understand that we need tax policy. I think now tariffs, I know everyone's unsettled. I do not like tariffs. I don't like any taxes myself. I'm a disciple of Arthur B. Laffer, Art Laffer, Laffer for those of you who know him. And yet I can see what he's doing. Think about the first 3 tax cuts he's announced. They're all for lower middle income. No tax on tips, no tax on Social Security, no tax on overtime. So that's how he started the tax discussion. If you listen carefully to Kevin Hassard, the next thing I think they're going to be working on, and it's a quid pro quo for tariffs. In the early days of this country, tariffs funded government. There was no income tax. Today, no, tariffs fund very little of anything. He might be introducing some of that balance in order to cut tax rates. So stay tuned, we'll hear, and that will unleash more animal spirits as well.
So last point on current events, so to speak, and then I want to go into the platforms and some of the developments that we're seeing, but DeepSeek, right? Everyone's talking
Yes.
AI, and DeepSeek kind of threw the market for a loop, perhaps an overreaction, but what are the implications of DeepSeek? And then with the announcement today from, gosh, it's escaping me, the other AI platform that came out today, that announced today.
Gwen?
Alibaba.
Yeah, Gwen.
Yeah, Gwen. Yeah.
Gwen. Yeah. DeepSeek, so interesting about this is both, well, DeepSeek is open source. Another one is called Kung Fu. It is also open source, coming out of China. Think about that. Excuse me. That's so new for China. So the question was, DeepSeek did rattle the markets because it claimed that it had developed R1, its reasoning model, on a high-end workstation for $6 million. In other words, the question was, wait a minute, is all the money that tech companies are throwing at data centers and GPU chips, do we need that? And so there's been a big shakeup. First of all, we do not believe that it was built on a high-end, the last leg of it might have been built on a high-end workstation for $6 million. But the company behind DeepSeek has a 50,000 GPU cluster that it used in pre-training. So it wasn't that inexpensive. But technology people are looking at the algorithm and said, that's pretty good. That was very creative. Essentially, unlike our reasoning models, which think, and they'll think for 10 minutes or 30 minutes, DeepSeek will start prompting with questions. Wait a minute, did you mean this or did you mean that? Because the way we speak is very imprecise, and so they want to get, they want better prompts, more precise prompts. So that's good, and now it's open source, so everyone in the US is using it, so that's great, it's good for us. DeepSeek is, all it's doing is following the cost curve that we have identified in AI. So this is on the inference side of AI, not on the training side. And according to our analysis, and we did this 4 years ago, the AI inference costs are dropping what we thought was 85 to 90% per year. DeepSeek is basically saying, well, maybe it's 95%. That's close, and our companies aren't far behind. So from that point of view, we don't think the market should have been shaken up. It's just an innovator. That's kind of surprising, that because China is not known for innovation in software. That's why this is such a surprise. But we think it's just part of the journey, and it's helping push us along the way to a future that even we who do this full time, we just cannot imagine what it's going to be like.
Well, I think you're pretty well known for making provocative forecasts and statements, and I think one of the most the biggest reactions I've seen in a while is the forecast for GDP growth that ARK is calling for.
Mm-hmm.
So I want to look at the audience when you say it.
Okay. All right, I'll set it up first so it won't be such a shock. And you understand there's some thought behind this. Okay, so the history of technology revolutions is that they cause a step function in global GDP growth. And so if you look at the 400 years from 1500 to 1900, real GDP growth, as best as Brett Winton, our chief futurist, in collaboration with academia can figure out, real GDP growth was roughly 0.6% per year. And then we had a technology revolution involving multiple platforms, 3 platforms: telephone, electricity, internal combustion engine, late 1800s, early 1900s. For the last 125 years, real GDP growth has averaged 3%, with China bringing up the rear, giving us that last push to sustain 3%. We have 5 platforms involving 15 technologies now. And personally, I think we're very conservative in our forecast, but you're right, others don't think so. We believe that real GDP growth will accelerate to 7.3%. Now, you're not going to get the shocks because of the way
Yeah. You ruined it for me.
So
I love it, though.
Yeah.
Everyone's like, what?
7.3%. I think that's conservative. But we want to be a little bit conservative because geopolitics are what they are, and there are a lot of things that could go wrong. But 7.3%. The other observation, though, is these technologies are highly deflationary. I just gave you inference cost declines, 85 to 95% per year. If you look at industrial robots using Wright's law, for every cumulative doubling in the number of industrial robots produced out there, so cumulative doubling is 1 to 2, 2 to 4, 4 to 8. For every cumulative doubling, costs decline by 50%. And we're at a very low base right now. DNA sequencing, that for every whole human genome sequenced, for every doubling of that, costs decline by 40%. In the EV space, the battery drivetrain technology, for every cumulative doubling in that, down 28%. That's why electric vehicle costs will continue to fall. So we're heading into what we believe is a deflationary environment, but deflation, good deflation. Good deflation. When you cut prices, you will get a boom in unit growth, and that's part of the productivity virtuous cycle here. So if we have 7.3% real GDP growth, we could have something close to 5% nominal GDP growth, which is not far from where we are right now. It doesn't sound like so crazy, but from a valuation in the marketplace, what will you pay for earnings that are caused much more by real growth and not by phony growth, inflation? You'll pay a lot more for that. And I do believe that is why the market's multiple is going up. The market is beginning to understand that productivity is surprising on the high side of expectations. I think it did today as well. And we do think productivity gains will go from this 2% range, towards the 5% plus range. Excuse me.
So we have 5 platforms you mentioned. I don't
Yes.
think we highlighted all of them.
Robotics, energy storage, artificial intelligence, blockchain technology, multi-omic sequencing.
And the global market capitalization of those 5 platforms in the public equity markets today is?
Roughly $19-20 billion. Trillion, sorry. It's really only gone up 30% in the last 5 years, whereas Mag 6 has, is it tripled or quintupled? It's gone crazy. It's the concentration, of course. So I think it's tripled. We think during the next 5 years, the category around which we've centered our research is going to be the real winner. Not saying Mag 6 won't win. I think our, bringing all of our analysts bottom-up estimates together, we have Mag 6 appreciation in the 20 to 25% range. Personally, I think that's too high. I think there's going to be more disruption in the Mag 6 than many people think. I mean, just watching Apple over the last 10 years since ARK started, we watched them carefully, trying to understand how much AI talent are they bringing in. By all rights, Apple should have the first autonomous vehicle. It is the ultimate mobile device, right? He should have, who was it? Steve Jobs should have accepted Elon Musk's offer to sell Tesla to Apple. And he would have had that car. I don't think they would have gotten along. It would have been a bust. So, but they have had so much trouble with AI. And, that's the lens we're viewing all companies through now. Do they have deep domain expertise first? Are they taking AI seriously? Are they bringing in the talent? Do they have proprietary data that no one else has? Those 3, we're looking at every company through that lens, because those are going to be the winners in the new age.
So $20 trillion global equity market cap today, going to, it was 200, is it still 200? Has that increased in the next 5 years?
I think that has gone, yes, it has gone up. But I should have it. It's in our Big Ideas 2025.
Well, there you go.
Can pull it up yourself. Yeah.
ARK-invest.com, Big Ideas 2025. Small plug. So let's go through some of there's the 5 platforms. They're innovative platforms in their own right, but really what's driving all of this, or catalyzing all of this, is the convergence across these platforms. And AI is really the backbone of everything.
Mm-hmm.
So, I get the most excited about what's happening in the multi-omic space, not just because of how cheap these companies are, really, but because they're curing diseases and no one cares.
I've never been in a market like this. If in the late 90s, if a company came up with a technology to cure sickle cell disease and beta thalassemia, which has happened, and that cure is now generating revenues, that company would have been worth $40 to $50 billion, because they would have done the analysis. The dream was right. Now, it couldn't have been done back then, but the company, CRISPR Therapeutics, that has those cures, is its enterprise value is $2.5 billion. And we think just from those 2 drugs alone, and they're in collaboration with Vertex, they'll get 40% of the profits. We think that share in 3 years, just from those 2 drugs, will be $2 billion. Now, clearly the market doesn't believe any of this. And in fact, as we're interviewing, as we do from time to time, we're bringing in research associates and others, multi-omic space, we will ask an analyst who's had experience in the marketplace, or in our market, how would you value a cure? And the answer invariably is, well, it's just really not going to mean much because you lose the annuity, associated with the chronic disease. Can't get that that daily fix. And if you go into Big Ideas 2025, you'll see that we expect cures to be worth anywhere from 2 times more to 20 times more than the therapies in place today that treat chronic diseases. And one of the biggest reasons is, thanks to AI, research and discovery is transforming. So the number of failures is decreasing rapidly. I think today 90% of most trials end up in failure. So those are coming down, those failure rates are coming down dramatically. And the time to conduct from research to through phase 3, we think is shrinking from roughly 13 years where it is now to 8 years, in the process of shrinking. So that the cost to develop one new drug, which today, including failures, you have to include that in this analysis, is $2.6 billion. We think that by 2030, that will drop to $600 million. But as far as a cure and why it's worth so much more, if you're curing disease, believe me, these people with unmet needs, I mean, sickle cell disease and beta thalassemia, what's their alternative? There's no treatment. They have to go to the hospital 10 to 20 times per year for an emergency room blood transfusion. So they want a cure, and insurance companies are willing to pay. That's been the biggest surprise. They're willing to pay $2.2 million for one and done, sickle cell disease and beta thalassemia. And they have no problem with it because it's saving the healthcare system so much money. We think there's going to be a big shift from sick care, which is 85% of the healthcare budget right now, to healthcare, more of it in the form of therapeutics, like cures. So if a company is curing a disease and people are lining up for it, what it probably means is the revenue is front-loaded relative to what we normally expect with drugs. And they won't fall off the patent cliff. They'll get all of that revenue instead of seeing their revenues drop by 80% when they lose their patent. So the other thing is, a cure is a cure. Phase 1 is all about safety in trials. Phase 2 and 3 are efficacy. By the time you get through phase 1 and into phase 2, you know whether you have a cure or not. And so it probably means that the phases are going to combine as well.
And then on the diagnostic side, you have companies that are doing early identification of cancer through liquid biopsy, which is just fancy language for blood tests.
Yeah.
We're talking about saving 70,000 lives a year in the U.S. alone by identifying cancer stage 1 versus stage 4, which improves your chances of survival by 90%.
Yes.
Through a non-invasive blood test.
Yes.
I think not Cologuard, Garden Health.
Yeah, Shield. So Garden Health has one FDA approved, And then after, also, so that's diagnosing. And then once diagnosed and treated, these molecular diagnostic tests in cancer are used for what's called MRD, minimal residual disease. So you'll go for your blood test, you know, depending on what the doctor, how aggressive the cancer was, every 2 months or 6 months or maybe 1 year, just to make sure there's no recurrence. I think the beauty of these blood tests, so tumors shed into the blood, is that with AI, we're able to discern a lot more from these blood tests. They're able to pick up on cancer 20 months on average before imaging can. So that's 20 months. That's discovering cancer for many in stage 1 as opposed to stage 3. So really going to save, yes, a lot of lives.
Yeah, and that's the standard of care today. If you are in remission and you're doing recurrence monitoring of certain types of cancers, but ultimately it will be the standard of care for screening for cancer. So today you have pap smear, colonoscopy, you know, mammogram. None of those are pleasant experiences. There's a very high false positive, sending people into a tizzy, myself included. You know, you get a false positive, you go back, and they're like, oh, sorry, that wasn't anything, we were fine. Blood tests should be a lot more precise
yes.
in identifying. So switching gears a little bit, I think we're probably the most well-known for Tesla, and the early call on Tesla, and that conviction has not waned at all, but increased. Do you want to talk about robotaxi for a few minutes?
Sure, and I did get a question beforehand. Tesla's under assault in the market, so yes, our conviction in Tesla has increased. The markets has decreased because of politics, and yet, you know, I've been around the track a few times and seen politics. Politics always gives way to economics, and if Tesla is able to deliver first, before robotaxis, a lower priced car in the $25,000 to $30,000 range, they're going to have a lot of people buying that car. Elon says there are people, you know, just waiting until prices drop because they just can't afford these ones. So that's the first thing. And then, yes, robotaxis going to launch in Austin in June. And what's wonderful about that from our point of view is analysts who follow Tesla like it's an auto company are going to have to add another part to their model for robotaxis. And as they consult, they will have to consult with tech analysts. The tech analysts will inform them, oh wow, this is a software as a service model. Oh my gosh, this is a recurring revenue model, and it should have 80% gross margins. Well, their EVs have 15% gross margins right now, and sure, Elon's aspiration is to get those into the 30 to 40 range, but they're at 15% right now. This idea of an 80% margin for a new line item, that is going to, you can tell the stock has appreciated. It's not treated just like a car company anymore. But when more and more analysts do the work and actually see how the model's going to transform, and we've put our model out there, they can use our model. We're quite happy if they do. They'll understand why we're using, why our target price 5 years out is $2,600, which is more than tenfold where it is today. So we think the story really has just begun, because it was always in our mind a robotaxi, autonomous, and now there's another layer to the story: humanoid robots. And you know, if you listen to Elon, he'll tell you he thinks that humanoid robots will be 5 times more valuable than robotaxis will. And our work suggests not quite that. we think that the revenue generation from autonomous, from robo-taxis, the entire ecosystem, that's going to scale into the $8 to $10 trillion range in the next 5 to 10 years, from almost nothing now. Huge opportunity, with the platform providers like Tesla getting half of that. So, very big idea. Humanoid robots, according to our work, will generate revenue ultimately, not next 5 years, not as quickly as autonomous vehicles, although it's happening more quickly now than we expected. In the $26 trillion range, half of that in the industrial world, half of that at home. So that's another big market they're going after. And the reason they can is it's the same 3 platforms at work: robots, energy storage, and artificial intelligence. Those 3 working together will create robotaxis and humanoid robots.
I'm looking forward to not doing my own laundry, putting away groceries, dishes, etc. I can't put a price on that. So we are going to come to Q&A, but before we do that, my colleague Matt Murphy in the back of the room and I have been working with Cathie over 8 years, and we've got to know you pretty well. And I think the public knows you really well as an investor, but they don't get to know you as Cathie the person. ARK is your 4th baby.
Yes.
You have 3 children.
I have 3 children, two girls and a boy.
And so I thought it'd be fun to get to know you a little bit, if that's okay.
Sure.
So I'm going to do a lightning round.
Oh my gosh, she's never done this.
Surprise!
She was going to do this.
Okay. Have you read a book that taught you something that you still carry with you?
Well, that one is very obvious. It is the Bible, and I named ARK because when I started really getting to know the Bible in 2006, you know, when you're going through a tumultuous period, and you know that's when this sort of thing happens. I remember I used to say, okay, God, just talk to me. Just tell me what you want me to do. You know, I'm here to serve you. And how many times did I open up to ARK of the Covenant? ARK of the Covenant is what the Israelites took into battle, believing that the presence of God was with them. And the presence of God was with them, just not in that little thing. I felt like in starting ARK, I would be doing battle with the traditional world, which, you know, really doesn't like what we do, doesn't understand what we do, because we're benchmark agnostic, and we use, as our screen for portfolios, we actually use research, like I did when I started in the business, and have always done.
What's the last song you listened to?
Last song? Gosh, I don't remember these things.
Do you have a favorite song? Or a favorite band?
I love U2. Now, U2 is from Ireland. My parents are from Ireland. I lived in Ireland when I was little. Love U2. I do.
Same.
Yeah.
Good one. Mm-hmm. What can always make you laugh?
My partner, Joe Brady. Joe Brady can make me laugh, and he makes me laugh because he jokes all the time, but I don't understand the jokes. And then he's like, oh, forget it. I can't explain this. Yeah.
Matt and I can relate to that. Although you cracked a couple jokes this week, and I was like, look at Cathie in 2025.
And I'm not funny.
What's one word your family would use to describe you?
Well, it's interesting. My youngest sister, what I heard her describing me to someone, and she used 2 words: fearless and passionate.
Absolutely.
Yeah.
And kudos to you for that, because your passion never wanes. Your conviction, it never wavers.
It's our research. It's all the research that we do. Yeah.
Okay, last one. What's on your bucket list? Vacation spot, and not that you're like one to lay on the beach, obviously. You know this woman, she's not resting and sunsetting. Bucket list or your next vacation spot?
I have to tell you, I'm just a pretty boring person. We moved to St. Petersburg in 2021. It is surrounded by water, and I am just happy as a clam there. I am. I feel like I'm in heaven.
And what did you say before you moved there?
Oh, as I was growing up in the business, New York City, 40 years in the city, I said so many times, because I saw all of the older people in the business retiring and going to Florida, I said, I will never move to Florida. That is where people go to die. And apparently there's a joke that St. Petersburg was, I don't know, someone probably knows this joke. It has to do with, you know, the grandparents and then the older people going there. I can't remember what it was, but it was considered the place where people go to die. And it is the youngest town now. It is so young. There's a university there, and we moved there. One of the reasons we did, besides taxes and weather,
Two good things.
yeah, we wanted to move to a community that we could help and we could make a difference. We have a very young employee base, and you know, they don't just want to walk in and out of the office and that's it. So they're part of a community that is very grateful to us. We've gotten involved in education, our research. We've hired now 4 educators to take our research and make it age appropriate. And it is throughout the Pinellas County public school system as part of the science curriculum. It's not after school, it's not, so very proud of them. Sorry. And then I'm at the end of what you're hearing, that's why. So, and then we also partnered with the city and on what's now called the ARK Innovation Center, and we're going to be incubating startups in there. We're starting early stage venture funds, and we'll house them there, and we will house any startups that want to move to St. Petersburg in that innovation center. So yeah, we're trying to make a difference.
It's pretty cool down there. Okay, I will stop asking questions. I could ask you questions all night long. I think the audience probably has some questions. I can come around with this microphone if that helps. Okay, let's start here.
Just something more out of curiosity, but I wonder if the Tesla robotaxi success, how that negatively impacts the actual sales of the car. Does the robotaxi business become so big that the car business dies or is negatively impacted?
Yes, it's a great question. We do think that it will be the commoditization of autos. Now, autos will probably, they'll become collector's items. There will be cars that people still want to race and they don't want electric, they want the sound of the internal combustion engine. But it's going to become that sort of thing over the years. These things take time, of course. I'm not saying this is going to happen, you know, in the next 3 years. But we do think it will lead to the commoditization. I mean, when a person wants a robo-taxi, they probably, for the most part, will not care. They just want to get from point A to point B in the safest way, the fastest, and the least expensively. And we think that's where transportation is going. Now, in terms of the number of cars out there, we have been, well, they peaked. I think auto sales peaked. They peaked a while ago. Of course, we had a surge during COVID. That was a special kind of peak. We don't think they're going to see those levels for quite some time because of this shift. I don't know if this is true in Atlanta, but in California, where I started driving, I'm hearing young people don't want to drive. They just want to take Uber. They don't care if they get their license or not. And they just want to look at TikTok. Right? They want to look at TikTok. Shall I drive or look at TikTok? It's obvious what they're going to do. So I think we're moving quickly towards that world. The young people certainly are embracing it already. And I think more and more people will over time. We believe that Tesla's cars will be safer than human-driven cars in the fourth quarter of this year.
Thank you.
Yeah, yeah.
Thank you. I love that you talked about industrialization and outlets. My question is how much of what we're seeing, the end of globalization, which has already been happening for a couple of years now, but I think it's going to be accelerated under this new administration, and the increase in nationalism, as with the AI arms race, and I think with energy.
Mm-hmm. Yes, it's interesting. China entered the World Trade Organization in roughly 2000, and that began the gutting of the U.S. industrial base. And of course, President Trump is very much on this bandwagon. No, we have to bring those jobs back. What may happen here, it's going to be very interesting. What I believe is going to happen is that the U.S. is going to enjoy something that China and other emerging markets have enjoyed when it came to telecommunications. They leapfrogged landline. They went directly to wireless. Same thing with financial services. They don't have a branch system, a bank branch system. They have digital wallets. They started WeChat Pay, and showed us the way. So they leapfrogged that whole brick and mortar infrastructure. I think what's going to happen here is we have demographic issues here. I think we're going to end up with the most modern, sophisticated, and productive industrial base in the world. Because it was gutted, and so, we can, skip to the next generation. Whereas in some of these other markets, I mean, they're going through some economic turmoil, especially in China. There are a lot of unemployed people, especially young people in China. So, they're probably good to, from a demographic point of view, they kind of have to automate. But this other point of view, they need to put these young people to work. So it's not going to be as easy for them to leapfrog into this new world because of that consideration. And you asked another question?
Increase in nationalism?
Nationalism. Yes, increase in nationalism. Yeah, I think this is a pendulum swing. I think this president is a very shrewd negotiator. I know it seems like chaos right now, but that's what a shrewd negotiator does. It makes everybody say, this is never going to work, So I think, personally, I think, we're going to be better off. I mean, we were supporting the rest of the world from a defense point of view. And now look what Europe's willing to do, $500 billion. We were footing that bill before. So I think he's a deal maker, and he knows we live in a globalized world, and he knows enough about economics to know that there's a law of comparative advantage. And if he doesn't, Art Laffer's in his ear, and he's got a lot of people I trust who will say to him, when we've corrected some of the excesses out there, okay, why don't we just cool it now? You've made your point. So, yeah.
Thank you.
So I'm a glass half empty fixed income guy, and I know you don't call shorts, but with disruption, innovation, what sector should I not own or single issue name that you would not want to own for the next 10 years?
Well, we think that these 5 platforms are going to sweep across sectors. So I think if I were a fixed income manager, I'd be worried about stranded assets, that are going to be obsolete. I'll throw out one first that will be a big surprise, because Warren Buffett would not agree with me at all. But we have done work on rails, and those have been great value investments, on average over the years. If we're right, autonomous truck platoons, are going to be able to transport freight less expensively than rail. So rail is 4 cents per ton mile. We think autonomous trucks will be 3 cents per ton mile. So, and trucks are more point to point, right? So there's that added convenience as well. So no, this is going to take a long time, but I'd definitely be focused on that, because I think the working assumption is those assets will never be stranded. Maybe they can be repurposed to high-speed rail over time, but that will take investment. I think our financial services are going to be transformed. I think many of the guys will end up with, just like in retail, online retail did not destroy Walmart and Costco. It destroyed a lot of other companies, though. So I'd be looking at, the old guard, gaining more share as more companies capitulate. So that could be good for some of your investments. I think the same is true of almost every sector. Financial services, the shift to digital wallets. Young people, there are surveys out there saying they'd prefer to go to the dentist than into a bank. I think that's true. I'm not in that category, but I also don't I haven't been in a bank for ages. So I think almost every sector is going to be impacted. I think healthcare, these companies, and any group of companies that has really listened to and played the game that short-term oriented shareholders wanted them to play. So buying back shares and churning out the revenues at exactly this every quarter and so forth. That kind of company in this new world, I think, is also going to be in trouble. You have to embrace these new technologies, and there's nothing. Healthcare is steady as she goes. There's nothing steady as she goes now, especially in healthcare, given how rapidly we think some of these movements are going to happen. I know there's an elephant in the room one that I'm not, but I think in terms of every sector having issues, because these technologies are going to be so pervasive. Yes.
Hey, Cathie, I was going through your ARK Invest portfolio this afternoon, and along with all the small and mid-cap names that you invest in, Roku, Roblox, CRISPR, there was one name that popped into me. And when I saw it, I was like, oh, Cathie would invest in John Deere.
Yes.
Why John Deere? You look at John Deere as being the old, stodgy agricultural, industrial equipment manufacturer. Are you looking at John Deere as Tesla?
It is one of the most important autonomous plays in the industrial world. And it's been working to this end for years and years. We talk to each other all the time. And, they're very, they're steady as she goes, good old John Deere. But this is the next phase of farming, which is really taking the farmers completely out of the equation. Some small farms will still exist. There will be gentlemen farmers. I'm not saying anything like that, but the, food production will be done primarily autonomously because, and it's not just the tractors. It is the drones that work alongside the tractors, and infrared technology showing the drones exactly where to apply, how much seed, how much, if any, pesticide or herbicide. So they're very sophisticated, and they've been and God bless them, they've been investing, just investing. Yeah.
An atypical question, and feel free to pass on answering it, ties back to your comment about the Bible and the naming of your firm. I'm curious to what extent your religious beliefs guide what you invest in, and if not so much, how you run your firm. And the reason I ask is, in my middle age, I find myself turning personally and professionally more towards my religion, not just for its spirituality, but for values, community, the concept of service to others. And I'm curious about an investment luminary that is vocally passionate about their religion, views that.
Yes. So 2006 began the journey, and I was at a moment saying, just as you say, as we get older, there are moments in our lives where we say, why am I here? Okay, why am I here? And I was in that moment, just show me, I'm pretty sure this is the track I'm supposed to be on, but what do I do now? Because that world I don't agree with anymore, in terms of passive, and agree with it in terms of innovation. We can't, they don't understand that you're not going to, you can't benchmark the future. We would like to be the benchmark for the future, but it doesn't exist yet, right? So as I was going through that journey and decided to start ARK, and that was, for those of you who are spiritual, that was a revelation, a Holy Spirit moment. I wasn't even thinking about work. But as I was moving more and more into this notion, okay, yeah, I should do this. One of my friends, who's a fixed income investor also, trying to understand why I needed to do this or why I had decided to do it, he said, and he's spiritual as well. He said, I get it. This is all about God's new creation. God's new creation. He took the position. He said, I'll bet God is not too happy that people are just investing in the past. And why are we here? We're here to procreate and create. And so this is and I thought, wow, that is great, because that does sum up, really trying to allocate capital to what we believe is its highest and best use. So that's part of, and then in terms of, I think, in the company, I don't wear it on my sleeve, but, for a very long time, I will very often say, oh, thanks be to God. But I mean it literally, right? Many people use that idiomatically, thanks be to God or please God, and those are all little prayers through the day. But I think, I think ARK is known for its kindness. If you come in and you visit ARK and the people in ARK, they're authentic, they're genuine, they're kind, and I think, hopefully it's part of sort of this desire to create a company that is very pleasing.
I wanted to follow up on your call for 70% real GDP growth. 7.3. And I was just curious, is that for the U.S. or is that global, and over what time frame?
Yes, that is a global number, and we actually have it scaling to that in the next 5 years. So yes, it is global, but we think the U.S. will lead the charge.
I just want to say we have about 10 minutes left and about 30 questions. So we're going to do a
lightning round answers.
Oh, lightning.
Okay, yeah, like, the
Okay.
questions are coming, but abbreviated answers.
Okay, in other words,
So abbreviated
I got
question, your position on Bitcoin, and is it a digital store of value? And ultimately, and if so, when does it disconnect from being a risk-on asset like it is these days?
Yes, so we do believe it is a digital store of value. It is actually a much bigger idea than that. And I know I have to be short, but when we did our first white paper on it in 2015, it was $200, and we wrote the paper, and I asked Art Laffer to review it, and when he reviewed it, he said, "This is what I've been waiting for since the U.S. closed the gold window 50 years ago, more than 50 years ago." This is a global, rules-based monetary system that's private, no throat to choke. It's a very big idea. We think it's the biggest of all of the digital assets in terms of ultimate accrual of value. So that was the first part of your question. I think there was another part.
When does it disconnect from?
Oh, risk off.
Risk on. Okay, risk on.
One of the reasons we moved in when we did, Greece was threatening to leave the European Union. And we saw Bitcoin moving up every time there was a threat. And I thought, does this have risk-off characteristics to it? Because back then it was wild and crazy days, right? And it turns out it does. And we saw it again in the regional bank crisis. Bitcoin took off before any other market because there's no counterparty risk when it comes to Bitcoin. Certainly not layer one Bitcoin, no counterparty risk, unlike what we were seeing in the regional bank crisis. So I think if we were in a financial crisis, of course the first order effect is correlations go to 1, and there's enough ownership now, including institutional, of Bitcoin, it would get hit as well. But if it's a financial crisis where counterparty risk is, as it usually is, the question, Bitcoin would start appreciate as everything else is selling off. We really do believe that.
I had essentially a very brief follow-up to Bitcoin question.
Sure.
Can you speak to your outlook on Bitcoin ownership by corporations like MicroStrategy and others, / the Microsoft shareholder proposal to put it on its balance sheet?
Yeah. We would be an advocate for it. Just like we're an advocate for countries to put it in their strategic reserves. Partly for the reason I just said, in terms of the, no counterparty risk, and and its store of value characteristics. Now, what is happening? We thought emerging markets would do more of this, both the countries and the companies, but stable coins, which are backed by the U.S. Treasury bills, are actually more important in the rest of the world for companies to use, and it's more in this country that we're seeing companies put Bitcoin on their balance sheets. So yeah, we're an advocate for it. It is, in terms of a monetary system, it's better than our monetary system because it's mathematically metered to top out at 21 million units. And having gotten to know some of the core developers out there, that is not changing, ever. So, whereas monetary authorities can pump the prime, if they feel they should.
Hi, thank you for your time, and I appreciate you touching on a few hot topics of the day. Considering we're at a Women in Finance networking event and all of the backlash that we've seen with diversity, equity, and inclusion in the headlines, I'm curious, as a woman in finance yourself and as someone who's passionate about innovation and what I assume is the diversity of ideas. What do you see as DEI's role moving forward and fueling some of this growth?
Yeah, so I've never been asked this question. This is very interesting. So if in the past, if I've been asked questions like that, I've often been asked, well, okay, what do you recommend, for young women? I actually answer it, and always have, that I recommend it for both young women and young men, because everyone, when they get out of school, is struggling, trying to make their way, right? And of course, the numbers and the stats show that, for some reason, women the numbers are much lower in areas like tech and financial services. This industry for me has been an oyster, but so what do I tell, and this isn't a DEI thing, because I think what I'm telling you is that's kind of not what I do. I like to encourage young people, women, men, and older people now too, because I think there's going to be a tremendous opportunity to transform with these new technologies. But what I usually say is, all right, the most important thing, young woman or young man, is make your boss look brilliant, because you know a lot more than your boss about technology, especially. And that's what I did. And what did I know? It was time-sharing system. I knew the time-sharing system, which was crazy, mainframes way back then. So, and I made my boss, now, if your boss does not give you an opportunity to grow, which you should deserve after 2-3 years, then it is time to move on. And I think sometimes what I witness is women are more loyal for longer than many men in the same position would be. And so, you have to advocate for yourself, and your mentors are very important. I had the most incredible mentors. They in the beginning they were all men, but then I had women mentors later on, and so I know that mentorship. I just heard you're going to have a session on mentorship. I think that's a great idea. The best mentor, and this is what I try to do at ARK at all times, the best mentor, you're in, let's say, the job with him or her, and he or she just explains along the way, teaches constantly. And the world is moving so quickly that is becoming even more important. And what I'm learning is I can learn more from young people today, much more than I was learning from young people 15, 20 years ago. So this is really a two-way street now, very interestingly. And I think because of that, we're going to see flatter corporations, because I think young people will develop momentum in their careers, because they're just so much more tech savvy. They're inventing it, they're cutting their teeth on it, So I'm sorry if I didn't answer the question directly, but that's where I've usually gone with that ilk of question.
My question is related to your GDP growth estimate and the increases in productivity that you mentioned you expect growth to be pretty high. So I think of that as a lot of people losing their jobs. And so with, for instance, the automated taxis and farm equipment and all the things that you mentioned, then if all these people are losing their jobs and all this productivity improvements occur, then who's going to be buying? Who's going to have the money to buy and produce that GDP growth in your analysis?
Yes. So the history of technology, did everybody hear the question? It was about productivity and isn't this going to throw a lot of people out of jobs? I think there's going to be job displacement. Re-education is very important. We have demographic shortages here. So that's at least a decent starting point. But the history of technology is a net job creator. Who could have imagined in the early 90s when Katie Couric was saying, what's this internet thing? Who could have imagined Uber or Airbnb? And those became, very important income to a lot of people and provided them with a lot of flexibility. I think we're going to see jobs. We cannot imagine the jobs that are going to be created. That's one thing. And I think that the fear, if you think about what happened during our move from the agricultural age to the industrial age, what happened was a lot of people who were never paid anything on the farm, they were family members, moved off and got jobs and independence in a way. There are driving cars, any of you with young children, I remember when I had 3 within 5 years, and there were birthday parties and sports and play dates, and it was like, oh my gosh. I wasn't paid for driving around, and that was hard work, by the way. I mean, that was nail biting, because we didn't even have GPS at that time. So, I could have used a lot more technology back then. But I think that we're going to see a lot of unpaid work move into paid. For example, women who do keep a home and have, let's say they have many children, maybe they'll have more free time to go out and get a part-time job because they don't have to do the dishes or any of the housework anymore. A humanoid robot is doing it. That's not tomorrow, but it's out there. So I think many people are surprised to learn how much unpaid work is what this automation is going to take over, freeing up people. But there will be displacements. Uber drivers, when I'm in an Uber car, I advise the driver to get together with a few of his buddies, get their money together, and buy Tesla's new small car when it comes out, so that they can put it on Tesla's network and become fleet owners instead of drivers. And you know what? They're very open to it. This idea that, oh wow, I could take more control of my life. This is very interesting. So I don't want to say there's going to be no transition. Of course there is. There always is. But the history of technology is it's a net job creator. And maybe the dislocations, depends on the kind of economic environment we're in, I think they'll be pretty mild because there's so much innovation happening and so many new kinds of jobs being created. We didn't have a prompt engineer title until ChatGPT. Now, prompt engineer, what does that mean? It means that people, even with linguistics degrees, we need precision in prompting. So I think some of the humanities with AI as sort of the centrifugal force around all of this innovation and precision being so important, I think we're going to bring in people into some of these technology-sounding industries that are from many, many different fields.
I'm sorry,
Last one.
well, hold on these guys, right? Yeah, we can't leave, these young guys have been waiting the whole time, we're so sorry. But we're gonna get you to the airport, don't worry. These 2 guys are sorry, we can only do 2 more.
How do you approach position sizing in ARK's portfolio? For example, like Tesla has like 10 to 11% percentage of the portfolio, while Roblox has like 5%. So how do you go about the process of choosing a specific percentage of each stock?
Yes.
Portfolio?
We have a 6-metric system, 4 of which are scored. So a score 1 to 10, so people management and culture, moat, barriers to entry, execution, product and service leadership, those are scored. Then we have valuation. I mentioned earlier, our working assumption is we assume any premium valuation is going to disappear in 5 years, and we have to assume that revenue growth and margin expansion will overcome those. Our minimum hurdle rate of return is 15% at a compound annual rate. And then the last score is thesis risk. Thesis risk has a lot to do with the sizing of the positions. And government regulation can be thesis risk. New technologies could be a thesis risk. If we think we have the disruptors and there's someone new coming through to disrupt our disruptors, we really have to. So sizing the positions, we use CAGR, compound annual rate of return, is on the valuation step. That's a starting point, but then all of these other scores factor in. Thesis risk probably most important in terms of sizing of the positions, but then the aggregate score also guides us as well, those top 4. So it is very bottom up, very company specific. This is not big picture, we think this is the biggest opportunity and that's the best company. No, a lot of bottom up rigor as well. Yep.
The real left.
Quick question about market structure. How do you think about asset flows and their impact on price discovery?
Yeah, they become a self-fulfilling prophecy in terms of the Mag 6. That's one of the reasons the Mag 6 did get to such a concentrated state. This is the pendulum shift from passive to active, and before 2020, there were, I remember Sig Segalis, Chief Investment Officer at Jennison, where I was for 18 years. He was in markets starting in the 50s, and he said, the pendulum swings, active, less active back then. That it became much more of a conversation as we went into the 80s and 90s. And we did see minor swings back and forth. We've not seen anything like this. This is a mega swing. And that just tells me we're getting ready for a mega swing in the opposite direction. And it'll probably be when, for some reason, some of the Mag 6 start disappointing, and some of our stocks are the reason why, right? Then they'll start thinking a little bit like, why is this happening? Then they'll be led to our stocks. Yep. All right.
Thank you very much, Cathie.